Hello and welcome to today's webinar, and thank you for joining us from wherever you are across the Asia Pacific. For those of you who don't know me, I'm Helen Steele. I'm the CEO of the Shared Value Project Australia and New Zealand, and we're delighted to be partnering with the Shared Value Project Hong Kong to bring you this widely anticipated session. But before we start, I'd like to encourage each of you to consider and acknowledge the traditional owners of the land in which you're joining us from today. For me, that's Melbourne, and I'd like to acknowledge the traditional owners of the land in which I'm meeting today, the Wurundjeri people of the Kulin Nation, and pay my respects to their past, to their elders, past, present, and emerging. When I began my shared value journey more than 8 years ago now, I recall that even in those very early days when companies were trying to understand the shared value concept about what it was, there was an enormous amount of discussion about measurement. How are companies going to measure and provide the evidence related to the economic impact, and in some cases, and sometimes more importantly perhaps, how are they going to measure the social impact related to their shared value activity? And then how they were going to report on that, and in ways that actually helped investors, analysts, and shareholders better understand how all of this relates to a company's corporate performance. It would seem that measurement was to become the holy grail of shared value, and this discussion is as topical today as it was then. So today we're really excited to explore a new report published last month by the Shared Value Initiative, Hybrid Metrics, Connecting Shared Value to Shareholder Value. This report addresses the current dilemma that investors are able to identify good companies and profitable companies, but not companies doing the most good, most profitably. This research makes the connection between companies who are adopting good business practices and corporate performance more explicit. And for many, this has felt like the missing piece that can cement purpose-led business and really advance that and take that towards business as usual. This webinar today is in part a replay of a webinar and a session that was held on September the 10th and hosted by the Shared Value Initiative as part of their Resilience Reimagined speaker series. We're fortunate to have with us today the report's lead author, Harvard professor Mark Kramer, and my very good friend, who is going to be available after the initial interview to answer your questions and participate in an online conversation with us. So that's really exciting. And joining Mark for the recorded part of the conversation today is Leanna Orr, who's deputy editor of Institutional Investor magazine. Just before we go to the interview, I'd just like to share a few acknowledgements. So the team at FSG, a not-for-profit social impact consulting firm, and the Enel Foundation, who contributed to this research and report, along with a group of expert advisors from the investment community. The Enel Foundation generously funded this research, and Susanna and Yara International provided additional support. We appreciate these organisations making the findings available to the Asia Pacific Shared Value community. And following the interview, Shared Value Project Hong Kong CEO Gail Wazo will introduce the live part of the webinar with Dr. Nadira, Lamrad, and Mark Kramer. So I encourage you to grab your cup of coffee or perhaps your lunch for those of us in Australia, and please enjoy this really engaging conversation between Mark and Leanna. Thank you.
Mark, I want to start by airing a complaint that you and I both know is all too common from both corporate directors and investors related to traditional ESG, which is there are too many rating systems, there's so many data sources, there are so many benchmarks, we don't know which one to follow. Tell me why the theory of hybrid metrics isn't just introducing one more set of standards.
Well, first of all, Leanna, thank you for being here, and it's been such a great partnership working with you. And I completely agree, of course. There are something like 125 different sustainability rating agencies. Studies have shown the correlation among them is only about 30% in how you do on one rating agency versus another. And there's just a vast amount of data. If you look at the GRI reporting initiative, it asks companies to report on every conceivable social and environmental impact that they might have. And of course, it's understandable because the origin of this sustainability metrics is really around holding companies accountable for their impact, and in theory, really for their negative impacts on the world. And so it makes sense that you ask them to report comprehensively on everything. And of course, different people have different views of what is a negative impact. For some, unionization, big anti-unionization is negative. For others, that's not an issue that they would take into account. So you end up with all these different rating systems, and none of them were intended to really help investors figure out which companies to invest in. And so when you get to that question, these systems really are not very helpful or informative because there are so many, because they are so contradictory, and because they're so idiosyncratic.
Mm-hmm. And so where does the theory of hybrid metrics differ?
So the idea of hybrid metrics is to say that within all of these different impacts that companies have, there are a very small number that are truly material to the financial success of the company. And so the first thing we need to do is focus in on those. And it doesn't mean that we shouldn't hold companies accountable for other impacts they might have. Of course, we need to hold them accountable. But from an investor perspective, we're interested only in those impacts that are truly material to the financial performance of the company. Recent research by my colleague at Harvard, George Serafim, in the last couple of years, has demonstrated that when you look at just those material, social, and environmental impacts, you can actually distinguish companies whose stock will perform better than others. Those who are doing a better job of managing the material impacts perform 3 to 6% a year better over periods of time, looking at thousands of companies. So even there are an awful lot of material impacts, and the connection between the impact and the financial performance is still rather hazy. So hybrid metrics is trying to zero in even further to say, let's look at where there is a clear causal relationship. And so for Enel, the Italian power company, one of the sponsors of the study, they understand that there is a clear relationship between renewable energy and profitability. Renewable energy is actually more profitable for fossil fuel. It lowers than fossil fuel power plants. It lowers their cost of capital, and it reduces volatility. So we know there's a direct causal relationship between their shift to renewables and their financial performance. So hybrid metrics says, let's create a new metric that is earnings relative to decarbonization. And we can actually compare different utilities to see who is decarbonizing most profitably over time. And so it actually uses the traditional financial measures of performance, pairs them with the relevant social or environmental impact, and enables you to create a simple number that you can then verify externally and compare across different companies within an industry on comparable terms.
It sounds very much like the old form of ratings.
Well, I think the old form of ratings does not...
Looking at it sounds much more in the language of an Ebitda than it does a...
Oh, yes, absolutely. I think part of its strengths is it's using traditional financial measures and combining them with the social and environmental impact. And so particularly as we see more and more trading going to algorithm-driven trading and so on, I think you need to find a quantitative way of assessing impact that algorithms can actually handle. They don't do so well at digesting sustainability reports of 100 pages long.
Does anybody?
No, nobody does. That's another pet peeve, I have to admit.
In journalism, we have, there's a common theory of original sin that happened with the early shift to digital, which was that outlets began by putting their information for free online and then had to move the Overton window, claw back the expectation that content was free to actually have semi-sustainable business models. I wonder, I have a personal theory that perhaps there's likewise an original sin that comes with sustainability, shared value, ESG, which is that it began from a place of subjective do-gooderism or values. And so that's where the language developed. And that has led to a lot of investors still to this day feeling that those things are luxuries to worry about or for somebody else or a nice story, but ultimately, if related to financial returns, probably negatively related.
Sure, I think that history is absolutely accurate, and I think that mindset is still very present in a lot of the investment community that says if you're taking into account social or environmental issues, it must be a matter of your own personal preferences, your own moral judgments, etc. And it isn't really seriously about finance.
It must be charity.
We simply think that's wrong. And if you go back to the work that my colleague, Professor Michael Porter, and I have done around creating shared value, the whole idea of that movement has been to say, really the greatest competitive opportunities, the greatest opportunities to make money are solving the world's problems today. And many, many companies miss this opportunity because they assume if you're doing something for a positive social impact, you can't be serious about making money. But we see that this was a huge omission in the work around corporate strategy. That in all of our thinking around corporate strategy, we ignored the external impacts that companies have. And it turns out those external impacts have very significant bottom line internal impacts that we simply had missed. And so if you think about Walmart, whose whole strategy is about lowest cost, until about 6 or 7 years ago, they had completely missed the costs of their environmental footprint, their use of energy, their trucking and transport and so on. By taking those costs into account, they've actually saved billions of dollars. And you can say, well, maybe the origin was a moral perspective about trying to make the world a better place, and that's true, but you can't deny the billions of dollars that they've brought to the bottom line by building environmental impact into their corporate strategy. And we think every company has an opportunity to build social and environmental impact into their strategy in a way that confers a greater competitive advantage and leads a path to greater profitability, which investors ought to be interested in.
So give us a few more examples of what these metrics are, what they might be, the material ones, the tie together the financial side,
Sure.
and the impact side.
Yes, absolutely. Alicia, maybe you can share your screen and put up one slide. And I want to emphasize that this idea of hybrid metrics is really a germ of an idea. It is not yet vetted and well established. It's not yet clear that it will work across different industries and across different metrics. But we think it's a promising path to begin to go down. So as we think about it, I mentioned that for Enel, the ratio of earnings to carbon intensity and for all utilities is a material metric. In retail, as we think about working conditions in the supply chain, or as we think about the waste that comes from consumers disposing of packaging, fast fashion, and so on, there could be a ratio of cost of goods sold to the value of the waste avoided or to working conditions in the supply chain. When we think about healthcare companies and pharmaceuticals and medical device companies, you can think about earnings relative to health impact. And for example, you could use the daily adjusted life years, a metric that the Gates Foundation came up to measure their impact on improving health around the world. In terms of financial services, you can think about the financial well-being of your customers. This is something that PayPal pays a tremendous amount of attention to and has built into their strategy. And so you can think about your revenue relative to how well off your customers are. In pulp and paper, one of the participants in our study, Suzano, a company down in Latin America and one of the leading producers of pulp and paper, has a different way of developing their pulp than many other manufacturers. They use fast-growing eucalyptus trees, and it turns out the fast-growing eucalyptus trees absorb a tremendous amount of carbon from the air, much more so than mature forests. So you can actually look at the sales of pulp and paper and the carbon that is sequestered. Another participant in our study, Yara, the Norwegian fertilizer company, has all kinds of technical assistance they provide and special formulations of fertilizer to help smallholder farmers all over the world improve their yield and productivity. And as a result, Yara has a higher profit margin than others in the industry. And so again, we can look at profitability relative to the yield per hectare of the customers.
Fascinating. Are you ever afraid that there may not be a positive relationship between certain material factors and financial outcomes for companies? And how should corporations handle that?
Right. Well, I mean, first, I absolutely agree that there are many situations where there are negative impacts. And I think hybrid metrics can be useful there too. For example, if you want to look at the profit of an automobile company and the average mileage of the cars it sells, you might find that they're highly dependent on SUVs and other vehicles with very low mileage. And so they have much more risk in a low carbon world than you would see by just looking at the carbon in their manufacturing process. But I think that the reality is that we know a great deal more about environmental impact and social impact and health impact than we did 50 or 100 years ago. And yet most of our major companies are still operating on business models that they developed 50 or 100 years ago, when we didn't think about carbon emissions. We didn't think about the social determinants of health and so on. So I think those companies face a choice, and they can either try and bury their head in the sand and hold on to sustain their earnings for another quarter by trying to preserve their traditional model and ignore what we know today, or they can reinvent themselves and actually come up with a much better business model based on taking into account the social and environmental impacts that we know are so consequential today. And we see companies making both choices. But we think pretty clearly that the companies that choose a shared value strategy where they're really rethinking their business model to take into account what we know today are the companies that will be most successful in the future.
Moving back to the origin of this theory, which you say is sort of at its beginning stages of application. When did you and your co-researchers realize that shared value needed hybrid metrics?
Well, it really goes back to our work with Anel, and maybe we can put up the next slide, because what we found is that Anel was very well aware that in shifting to renewables, they were increasing their profitability. If you could advance to the next slide, thank you. But they weren't telling their investors that. You know, they were very proud of the shift to renewables in their sustainability report and their contribution to meeting the Sustainable Development Goals, and they talked a lot about it, but they never really thought to talk about it in their investor and analyst presentations. And again, this goes to the mindset that we see throughout companies around the world, that if you're doing something that has social and environmental consequences, you think about it in terms of your reputation, in terms of the NGO community, in terms of government, but you don't connect it to your investors. And so finally, last year, Enel, in one of their Capital Market Day presentations, began to talk about the economic benefit that came from their shift to renewables. And they found that in the weeks following that presentation, their stock price actually increased by 24%. It hit an all-time high because investors could begin to understand the connection between all this talk about decarbonization and the actual impact on Enel's bottom line. And so we began to think about, well, how can you communicate more effectively to investors this connection between what you're doing as a company that in terms of environmental impact and how that affects your bottom line. And so we said, well, let's look at a couple different European utility companies, competitors of Enel, and see what happens when you look at the ratio of Ebitda to carbon intensity. And what you find is that Engie is the company that is most rapidly decarbonizing, but they're losing money. They're not profitable. Iberdrola is decarbonizing quite rapidly and doing it quite profitably. And so when you look at their score, they come out way on top, and that's actually consistent with their score on many of the sustainability rankings that puts them as #1. When you look at Enel, they are decarbonizing not quite as fast, but they are doing it, again, profitably and more profitably than Engie. So this is a simple metric that enables you to look at one number across all players in an industry and begin to say who is decarbonizing most profitably. And presumably those are the companies you'd want to invest in for the future.
And the concept of internal reward for corporations was, I felt, a really strong, almost psychological insight that you provided, you and your co-authors.
Sure. So, you know, if we're correct that what a company does around social and environmental impact on material issues affects their bottom line eventually, it will show up in their earnings eventually, and it will show up in their stock price eventually. But the problem is, without a more immediate indicator, it doesn't show up in the stock price. And of course, we know that the leaders of most major companies are compensated primarily in terms of stock and stock options. So if there is no reward in increasing the stock price by decarbonizing, for example, in the case of Enel, there's actually a rather strong disincentive for CEOs and boards of directors and other senior corporate leaders to be investing resources in decarbonization or whatever the relevant material, social, or environmental issue is. So we think that the real power of the hybrid metric, if it begins to be truly developed and adopted, is that companies can see the reward in a more immediate increase in their stock price from the longer term strategies that they're pursuing around positive social and environmental outcomes. And that should change corporate behavior. And I'll say there's one other dimension, which is there are no good internal tools for managers within companies to use when they're making investment or capital allocation decisions that enable them to not just look at the internal rate of return, but to also factor in the social and environmental impacts. And so we look at a company like Discovery out of South Africa, a life and health insurance company, that has done just an amazing job of developing incentives that actually lead their customers to have healthier behaviors. And that as a result, their customers actually have lower medical costs, longer life expectancy, and therefore Discovery is more profitable than other life and health insurance companies. And they have a formula they use internally that correlates the incentive and the cost of the incentive with the change in behavior, and the change in behavior with the change in health outcome, and the change in health outcome with the change in cost to the insurance company. And they can use this formula, which is beautifully combining both social outcomes and financial costs and outcomes to calculate what additional incentives they should be investing in. And this is the kind of equation that I can see other companies and other industries beginning to take into account.
What gets measured matters.
What gets measured matters absolutely, and what affects your PE matters.
I feel like many of the participants on this call, particularly those who work on the corporate side, but perhaps as the head of sustainability, or specifically focused on the value, the non-financial value side, are totally aboard with these kind of initiatives and believe in the long-term financial value of pursuing them. And yet often it's a matter of winning over and making it relevant in the CFO and the CEO suite, which is something, as you say, that implementing hybrid metrics internally can have a very, very powerful effect. When should these become part of a corporation's process and journey?
Well, you know, the first thing is I think it really does require differences internally in how corporations operate and how they are structured, frankly, because honestly, the sustainability officer and the chief financial officer and investor relations and the head of strategy are rarely in the room at the same time. Three of them might be, but sustainability typically isn't there. And unless you bring sustainability and investor relations and finance and strategy together internally in the company, you're not actually going to be able to report hybrid metrics, but more importantly, you're not going to be able to make the decisions as a company that enable you to perform better on the hybrid metrics. And so part of it is where sustainability fits in the corporation. And there's still an awful lot of companies out there that think this sustainability stuff is just about reputation. It's just about their brand and their image and whether they're getting picketed by NGOs and so on, and are completely missing the significance of these issues for their bottom line performance and their competitive position. And so we think that there needs to be a shift in how companies begin to factor sustainability into their strategy, their operations, and their financial reporting. And I'll tell you, you're absolutely right. There are a lot of CFOs and CEOs who, you know, yawn when they hear talk about sustainability and environmental impact and so on. But when Enel saw their stock price go up 24%, they said, you know, this seems to matter. This seems to matter. No more yawning. No more yawning.
And yet, Bobby has observed that even with corporations that she's been in contact with that seem to have fairly advanced or serious commitments on the sustainability side, may not be using hard metrics or tying it to finances. So this is something that
I think progress can
be happening now. We're at the front edge. Is that accurate?
Oh, we're absolutely at the front edge. And again, it's a difference in mindset, because all of the sustainability measures that are out there were really developed about holding companies accountable for negative impact, were developed by people who care a great deal about social and environmental impact, and in many cases don't care much at all about whether a company is making money or not. In fact, you know, a lot of them think companies like Pepsi or Coke should go out of business because they're creating products that aren't necessarily good for people. But what we're seeing is, again, a shift to begin to bring ever closer the social and financial metrics. And so, you know, the hybrid metrics really grows out of a movement that has been happening for many years. The idea of integrated reporting has been around for about 10 years. Something like 78% of the 250 largest companies in the world now put some sustainability data in their annual report or financial reports. There's been a steady movement, but it's been very confusing because, again, there's so many different measures out there, and it's tended to revert to this rating system where each rating agency has its own definition of what's good, and therefore comes up with different metrics from the others. And it's got to be simple. I mean, my colleague George Serafim at Harvard now is leading an initiative on impact-weighted accounts, which is actually trying to monetize the impact of products and company performance on social and environmental issues. but it's very complicated. I think one of the great virtues of hybrid metrics, if indeed it pans out as people begin to explore it further, is the idea that it's really quite simple. We're putting a couple different numbers together and getting one number that helps us compare across an industry, and again, that can be externally verified by an accounting firm. And I think that kind of simplicity is essential if this is really going to be something that investors take into account.
In some ways, I feel like you and your co-authors are doing the work that perhaps could be done by financial analysts.
Yeah, and I wish they would do it for me. That'd be great. I think that's true, but again, we've talked about this mindset, and I think it is still very much there in the analyst community, that social and environmental issues are kind of fluff, that they're not really about, immediate or at least short-term, near-term financial performance, that they're not really material, they're about public relations, and that all these different ratings and reporting requirements and so on are just impossible to meaningfully deal with and compare consistently across companies. But I think that it also requires, to do this, it requires analysts to be quite knowledgeable about social and environmental issues and trends around the world. And that's not necessarily an area of expertise. We did do a little bit of analysis just with the companies we looked at and found that those who were better at disclosing their shared value strategies actually had fewer earnings surprises. And so we do think that this disclosure is relevant to analyst estimates of earnings, even in the near term. But again, it requires analysts to think differently about how social and environmental issues matter. And that shift is a shift in perspective that is not easy to make happen.
And from the investor community that I speak to, which are primarily large institutional investors, ESG aside, I think that there has been growing dissatisfaction or perhaps disinterest in the analyst community. That a perception that particularly as institutions, what analysts care about and score and the horse race that they're interested in is quarter to quarter, which if you're $200 billion state teachers investment fund or a sovereign wealth fund, you don't care.
Yep. Yeah, I absolutely agree. There's long been a mismatch between the analyst community and the asset owner, or between the investment advisor, frankly, investment manager, and the asset owner, because most asset owners do have a long-term perspective. And I know GMO, Grantham Mayo Van Otterloo investment firm, talks about the difference between career risk and financial risk. Mm-hmm. And as an analyst, when you get things wrong, put it another way, when you get things right, but that's in the long term, and in the short term, things move the other way, you have severe career risk. You may not have financial risk because ultimately you may be right in the long term, but it's really hard to withstand the career risk of being wrong in the short term. And so I do think that there is a sort of structural problem in how we reward analysts and what we expect them to do relative to what is in the best interests of the asset owners for the long term.
Well, I think you will agree that it was a very informative session, discussion on the urgent need for a new set of metrics to identify those companies doing the most good, most profitably. As Leanna commented, what gets measured matters, and investors are currently missing a significant part of the picture with metrics that are available now. So welcome to the live section of our Hybrid Metrics webinar. I'm Gail Loiseau, the CEO of Shared Value Project Hong Kong, and together with Shared Value Project in Australia, it's my great pleasure to welcome Mark Kramer, who is joining us from the East Coast of the US. So, Mark, you are the lead author of the Hybrid Metrics report and the subsequent institutional investor article. You are the co-founder and a managing director at FSG and a senior lecturer at Harvard Business School, where you teach CSV, Creating Shared Value. And you're also a board director at both Shared Value Project in Australia and Shared Value Project Hong Kong. Please allow me to introduce our moderator, Dr. Nadira Lamrad, who leads the Sustainability and ESG Advisory Team at the Business Environment Council here in Hong Kong. Thank you for joining us, Nadira. We're delighted to have you here to bring your Asia perspective to the hybrid metrics conversation. So Nadira is well-respected in both corporate and academic circles. Dr. Lamrad has, for the past decade, applied her wide-ranging expertise to cultivate thought leadership around corporate sustainability, helping to foster collaboration and debate within the business community. She works with corporate clients on how to develop and communicate practical sustainability strategies, initiatives, and performance. She monitors and analyzes the latest market and regulatory developments to advise clients on potential ESG risks and opportunities. So for the audience, please continue typing your questions in the Q&A box. We can see that. And Nadira, I'm sure you have many questions yourself about Mark's call for a new approach to reporting shareholder value. So over to you.
The first question that came to mind when I read read the report, read the institutional investor article, and then also watched the video was, it sounds like we would need to, if it's a company and the company wants to start to think about hybrid metrics, it sounds like the company would need to first think through what are their ESG risks, and then in relation to their business, and figure out what of those risks is material risk and where they need to focus their efforts. Would you say that that's a correct assessment?
Well, I think that's true, but we do tend to think about it differently in that we think about the opportunities companies have to increase profitability, to innovate, to enter new markets by having a positive social impact. And so we don't think just about the risk of negative social impacts, but we think about the opportunities behind positive social impact. So a quick example, I mentioned Discovery Life Insurance and health insurance company that actually has developed incentives that reward their customers for healthier behaviors, eating healthy, preventive health care, exercise. And they find that their customers respond to the rewards so that they actually have 15% lower medical costs, and their customers have about a 10-year longer life expectancy on average, which makes them a more profitable life and health insurance company. So I think one of the fallacies of the way many people approach ESG reporting is that it's only about risk. And we see, in fact, that it's about opportunity. Now, for that opportunity to be fully realized, companies need to build positive social impact into their competitive strategy and competitive positioning. And it's really only once you've done that that hybrid metrics are going to be meaningful. Because if you're doing something peripheral that is being done for your reputation or license to operate, or you're doing it through charity and it's not really part of your business model, there's not going to be a causal connection between the positive impact you achieve and the financial results you deliver. And so hybrid metrics won't make sense in that case. So really the first step is, I think, to move from risk to opportunity. The second step is to build social and environmental impact intentionally into your competitive strategy and positioning. And then the third step is to communicate that to investors through hybrid metrics.
I think that just there we've answered already one of the questions from one of the participants. So I'm wondering if you're saying that, okay, the first step is identifying or moving from ESG risk to thinking about opportunities. So it's really about a mindset, a shift in mindset internally. So how do you suggest that happens? What is the best approach to kind of drive that change? And that's a major barrier in this region
It's a major barrier all over the world. And as we've worked with companies over the last 10 years on creating shared value strategies and taught courses on it, both to executives and students at Harvard, shifting the mindset has been the hardest challenge because people assume that social problems are solved by government and nonprofits or NGOs, not by business. And people assume that if you're doing something good as a business, you shouldn't really be making money from it. And that when you're addressing social or environmental challenges, you're kind of doing it for reputation, so you don't really make a rigorous business case analysis of the decision. And if you don't do any of those things, you're not going to be able to create shared value. And so getting people to understand that business can make money, lots of money, from having a more positive impact in the world. And actually, to do that, you need to develop the rigorous business case and build it into your strategic positioning. That is the hard part. And in some sense, it's a generational shift. I think that younger folks today are much more comfortable with that way of thinking. The whole development of impact investing and social enterprise has helped blur the line between those of us who want to do good in the world and those of us who want to make money, and recognize that you don't have to choose. So I think it's getting better, but there's no question that the mindset is the big obstacle.
Right. And that brings up two questions from myself as well as from the audience. So the question I have is, you had already in the recording, we heard about the sustainability team coming in and talking to the investor relations and maybe the finance team and so on and so forth, operations, etc. So how or what is the best way to accelerate this change, and how to where does sustainability need to step in? I'm asking, of course, for my own self-interest because I'm a sustainability practitioner myself.
Well, you know, again, I think the experience of working with Enel closely was so fascinating because they knew internally that the shift to renewables was more profitable, but they never said it to their investors. And one of the reasons, of course, is the sustainability team was never really in the same room with investor relations or rarely with finance. And they've actually made a shift since this report was developed to actually have sustainability now report into the CFO, which is still quite rare, but I think is necessary. But as we said, it starts with the mindset. You know, if the CEO doesn't recognize that sustainability is relevant to your strategy and to your financial results, you're not going to have an organization that brings the right people together in the right way. And as to your question of how do you drive change, you know, again, I think when Enel saw that communicating this message dramatically increased the PE ratio at which their stock traded, they paid a lot more attention. And I think it's only when companies are really rewarded by the investment community for making this connection between social environmental impact and financial results that companies are going to take it seriously. But, you know, CEOs' stock compensation and stock options is what drives their compensation overwhelmingly. So if you can show the CEOs of the world that by communicating through hybrid metrics, they will improve their stock performance, I think that will happen pretty quickly.
And that one of the questions, that the second question in relation to the previous comments that we had covered already was comes from Madeline, actually, and she's asking, will growth in green finance drive the development of internationally accepted measures?
Sure, and I think, you know, green finance absolutely has, and it has created the need to measure the environmental impact of whatever the money is being spent on in order to justify the green labeling and presumably the lower cost of capital. But the bigger challenge, I think, is around social impact. We're pretty good at measuring environmental impact around carbon and waste and other things. We have a long way to go in measuring social impact in terms of the well-being of our customers, in terms of the well-being of our employees. And those things are, I would say, equally important when you begin to think about how social and financial, social issues affect financial performance.
Right. And that actually, moving from social impacts, just now a comment came in from Donna, and she's saying sustainability is often equated with environmental impact. So is it easier to develop competitive strategies and business models around that rather than social impact?
So we've now been teaching creating shared value at Harvard Business School for about 6 or 7 years, and we've built up a couple dozen case studies, in-depth case studies of companies that are really gaining competitive advantage through positive social impact. And most of those are not environmental. I mentioned the Discovery Life Insurance. That's not an environmental impact, that's a health outcome. When Walmart improved the training and the pay and the opportunities for advancement of their workers, their frontline hourly workers, they saw a big drop in turnover, a big increase in productivity, and it improved their financial results. So I think the environmental area is the one that's easiest to measure. It's the one that is, of course, critically important, has gotten a lot of attention. But one of the reports we did recently is on the competitive advantage of racial equity in the United States. And it gets to the question of structural racism in the US and the impact that has had on business models, and the fact that we are shifting to a country that will be majority people of color. And many companies are not well situated to serve those customers or to hire those people as employees successfully. And so we've seen companies gain a competitive advantage around integrating racial equity practices into how they operate the business.
Right. Yeah, we've seen that quite a lot with Nike, for example, and so on. Right. Okay, so going back to hybrid metrics in particular, for the initial thought for me was because we're doing some work around TCFD right now, was that actually this is that final step, the climate related financial disclosures. It sounds like this is sort of what you're showing the world, that actually we can start to measure this information in financial terms, because this has been kind of a sticking point actually when it comes to TCFD.
I mean, it's real. What you do that has environmental consequences also has financial consequences. For a long time, we just never connected the two measurement systems. One was financial performance, one was ESG. And, they came out of different origins, different mindsets. ESG and the whole sustainability movement was really about holding companies accountable for the negative impacts they have in the world. And that's fine, and that's important. But it sort of overlooked the fact that some of those impacts are really material to your bottom line.
Yeah.
And so I do think, in some sense, hybrid metrics are the final step. But I also think we can't limit ourselves to hybrid metrics. Hybrid metrics will only work if you pick a very few truly important impacts for a given company. But you still do need to hold companies accountable for whatever their impacts are. So the carbon footprint of a bank is never going to be a hybrid metric that connects to the bank's profitability. On the other hand, you still have to hold banks accountable for their carbon footprint. And so in that sense, I think hybrid metrics can be extremely helpful, but they don't replace the need for GRI reporting and other kinds of ESG and sustainability reporting. Right.
So it's kind of narrowing down to those specifically financially material impacts. So it's not really about the wider environmental and social impact, but more those impacts that would have an effect on the finances, or the earnings, the growth, revenue, etc.
Right. And one of the points I tried to stress is we need to focus on where there is a causal connection that we understand between the change in the social and environmental impact and the change in financial performance. Because of course you can draw correlations between any two sets of numbers, but that doesn't mean that they're reliable. So we have to start, and this is why it starts with the business model and strategy of the company. Because if they aren't intentionally focusing on social and environmental impacts as part of their competitive strategy, then there's not likely to be a causal connection. So again, it's a narrower data set than ESG reporting in general. It's not going to satisfy all the socially responsible investors in the world or all the ESG investors in the world, but it will help analysts and active portfolio managers who are trying to improve their returns to better identify what's affecting the company's financial performance in the next quarters and years.
And speaking of that, because you're now talking about hybrid metrics as a way to look forward into the company's plans, their potential profitability in the future, but you're still discussing, I mean, earlier there was a lot of discussion about immediate returns or immediate rewards in terms of the stock price. And I'm just wondering the information is a snapshot in time, it's today. So how do you take these hybrid metrics and make them into information that's forward-looking, that provides that kind of detail, which would be useful, especially in the shift now towards active ownership and engagement with companies.
Right. Well, I mean, you can look at it as a static point in time. What is the profit relative to the CO2 intensity? Again, just to stick with an L. Or you can also look at a trend. I mean, one of the other analyses we did in our report, which goes a little more depth than the article, is to look at the compound annual growth rate of decarbonization and the compound annual growth rate of Ebitda, and to draw a connection between those two so that you get a sense of the trend. But I think the most important thing is the ability to compare across companies within an industry. And also, to the extent companies have announced their sustainability plans and goals, and many companies have said, you know, we're decarbonizing by X, or we are going to focus on racial equity in our hiring, or whatever it might be, then you can begin to connect those commitments for future behavior to what ought to happen in terms of financial performance as the company realizes those ambitions.
Okay. And one of the challenges now here in particular, one of the arguments that I've heard a lot, and because TCFD basically asks for forward-looking information, financial information, and it should be in your annual report. Now, the challenge that we've had or a bit of pushback around this because of the liability issues, concern over impact on the stock price or shareholder value as a result of the data being put out there. And a lot of the time I would see that the argument is actually this violates our fiduciary duty. So what are your thoughts on that related to hybrid metrics? And have you heard that actually already?
Sure, absolutely. I mean, you know, if it is true that these factors are material to the future financial performance, then it is in fact an obligation of fiduciary duty to disclose them and to pay attention to them in your investment choices and decisions. It is absolutely true that companies are often reluctant to report anything they don't have to report, to give away data that might be somehow helpful to a competitor, and that the entire legal department is focused on keeping the company from saying anything on which they might be sued.
Right.
And, you know, these are real constraints. One answer is to the extent that some of hybrid metrics can be calculated by analysts or the investment community with publicly available data, as we were able to do with Enel, again, and some of these other companies. It doesn't require the company to disclose anything new. It may simply require analysts to look at the data differently. But I also think, as I said before, if companies begin to find that there is a real reward in their stock price, in their PE ratio, they're going to make sure that the lawyers get comfortable with the disclosure that they want to make.
Right. So it's, in some ways, we're kind of experiencing a shift in the definition of fiduciary duty as well.
I don't think it's a shift in the definition, but I do think it is a shift in the data that is relevant. The definition is the same, but I think we need to recognize that social environmental issues do have material consequences for financial performance.
Okay, so let's go back to the question of who then, if it's not companies directly releasing this information, who then should be responsible for mainstreaming this idea and implementing hybrid metrics? So you had already mentioned that analysts maybe could start doing this. Whose role is it? Is it accountants? Is it the company themselves? Is it, for example, the regulators? So what are your thoughts there? What do you imagine?
This again is meant to be a tool to aid investors, really, by helping them understand a factor that is material to future performance that they may not be integrating into their analysis. So I would think that the active portfolio managers, or those who are constructing algorithms that they're using to select stocks, really ought to be the ones to lead the charge. We've seen a very small number of investment firms that do really intensive bottom-up research that focus on sustainability, generation investment management that the former US Vice President Al Gore started with David Blood, a Goldman Sachs partner, that has been the top performing long-only global fund for most of its 12 or 15-year history. Does this by really taking sustainability into account in how they select the companies that they invest in. And there are a handful of others, but it's still a small number because it requires really intensive bottom-up research. I think hybrid metrics are a way that a larger community of investors, portfolio managers, and analysts can begin to factor social environmental dimensions in, not to the same depth, but to a meaningful degree. And so I really think that, companies that have a message that is positive, that they think will result in improving their stock value, are going to drive it. And active investors who want to show that their portfolio is delivering alpha are going to want to drive it.
Actually, my view is that that's probably the best approach to drive it here as well, because it is that the investors kind of putting a little bit of pressure on companies here grabs the attention of the board and the senior management, right? And then suddenly there's an interest in, well, what are we doing when it comes to environment?
Absolutely. And when Professor Michael Porter and I wrote the article on creating shared value coming up to 10 years ago today, a lot of companies sort of dismissed it as just a new version of CSR and didn't really see it as competitive strategy. But as companies began to adopt it, their competitors paid attention. And really the only way that shared value has spread is that it delivers results, successful results to companies, and then their competitors have to start paying attention. And I think the dynamic will be the same here, that if hybrid metrics really do enable investors to improve their performance, others will take note, and that will be what drives acceptance.
Following up on that, here we have a comment from Wander and a question. Hi, Wander, who is based in Hong Kong. He says, most examples of successful shared value-oriented companies, including the power companies mentioned, are Western multinationals, and there are hardly any Asian companies which are embracing hybrid metrics. So there are some, but a bit of progress, but the mainstream corporate metrics in this part of the world are predominantly financial. I completely agree. So how can we accelerate the mind shift at Asian multinationals? And this is actually, I think that we had already mentioned earlier just now that the investors pushing things, especially we find that investors outside of Asia, but also a lot of investors, a lot of these companies are starting to build up their ESG teams here in the region. So we are seeing a little bit of pressure that way. But any other thoughts from you around that?
You know, I think I'm kind of a victim of circumstance or convenience in that it is easier for me to come across examples of Western companies, particularly as I'm trying to build out a curriculum at Harvard, than it is. But we've seen companies all over the world. I mean, Ayala is a company that has developed a lot of shared value initiatives that are material to their performance. AIA has actually partnered with this Discovery Insurance model and brought their model of promoting healthier behaviors to South Asia. We see a number of examples in India. We've seen examples in Australia. Several of the banks have built shared value into their strategies. I think it is not limited by any means to Western multinationals. I think it's simply unfortunately, you know, the lens through which many of my examples have been collected. Okay, so I agree. I actually think that, well, as you said, it's just the convenience and the circumstance of being a researcher in the U.S. But agreeing with Wander, I think that there is a lot of room for growth here. But one of the things that might pop up, or one of the arguments that sometimes we hear is, I'm focused on environmental or economic development. You know, I just want to be a successful company. I don't have time to think about sustainable development, or I don't have time to think about environmental impact, and that's only for big companies or those companies that are extremely profitable. So what's your answer to that? No, I think there are wonderful niche companies that have found an opportunity in creating shared value. You know, there's a cell phone company in Africa that offers life insurance, and the amount of life insurance is based on the number of minutes you talk in a month. And I mean, this is a very low price product. It's for low income populations. The amount of the insurance is $100 or $200, which is material, but you know, not huge. And the reason to do it through cell phone minutes is it avoids the adverse selection of only people who are sick buying life insurance. And also, life insurance is a very hard concept to communicate to people who have no knowledge of insurance. And so by tying it to the cell phone minutes, they've reached a population of, I think, more than 100 million people. And these people are not switching cell phone plans once they're in this program. You know, we've seen, I often use an example of an eyeglass manufacturer that found a way to make eyeglasses that you could just adjust the lenses with dials on the side, and you don't need to go to an optometrist to get a prescription. You just put on the glasses and turn the dials until you can see. There are many, many opportunities for new businesses, startup companies, to innovate by offering solutions that solve social problems. And many of the large companies are just never going to get their act together to shift. And so I really think that there's immense opportunity for newer companies, smaller companies, and of course, with the growth of impact investing as you know, now a dimension of venture capital, we are seeing examples of companies whose whole business model is based on delivering positive social and environmental impact. So earlier, we started this whole conversation with, is it about risks? And you'd mentioned opportunities, strategy, and I suppose at the end of the day, it is kind of a change in business model. It is. You know, most major companies have business models that were developed decades ago, some cases centuries ago. We didn't know about social determinants of health. We didn't know about climate change. We didn't know that tobacco caused cancer. And those companies have a really difficult choice as to whether they're going to reinvent themselves to a new business model based on what we know today, or just sort of stick their head in the sand and try and lobby to prevent legislation and hold on to their old outdated business model for as many quarters as they can sustain it. You know, that obviously is not, I believe, the right way to do business. Nobody would start a company today without paying attention to carbon emissions. Nobody would start a healthcare company today without talking about social determinants of health. And so I think it's a question of these larger companies that are rigidified, that are trying to satisfy stakeholders with predictable earnings every quarter, adapting their model. We're seeing it with automobile companies as they try and shift to electrical cars. You know, Tesla can be marginally profitable or lose money, and stockholders are delighted to pay a premium for the stock. When General Motors or BMW begins to reduce their margins by investing heavily in developing electric cars, they get punished in the stock market because their margins have gone down. But the reality is they are making a necessary investment for their future success.
Okay, so let's say we've convinced everyone internally and everyone's aligned for companies that, okay, we want to move forward with this concept of hybrid metrics. So what is really the first step? What do they need to do?
I mean, I want to be clear that this is an idea. It is not yet a proven formula or concept. We think there's something here. We've looked at a handful of companies and we've found meaningful correlations. We've also found that it makes a difference in the extent to which they disclose this kind of information makes a difference in the accuracy of the earnings forecasts and in the stock performance. But we really need to do intensive research, and hopefully the next phase of work that we are beginning with the Shared Value Initiative and at Harvard is going to back test this, is going to look more comprehensively at different companies within the same industry, is going to look at, you know, again, a wider geographical lens, and really try and figure out how we go from this beginnings of an idea to a formulation that people can actually reliably apply. But we have a long way to go to get there.
Okay, let's go to specific questions that we've received. So I'll go back to the Q&A, and please keep to the participants, please do go ahead and keep filling in your questions. We're happy to answer as many as we can. So the first question, I think that might be interesting here, is such metrics would be very effective as a criteria for inclusion into sustainability indices, perhaps. So is this, what do you think about that?
Yes and no. Certainly it will pick up a small number of the most material sustainability impacts. But again, we do have to hold companies accountable for whatever impacts they have, even though it may not be central to their business model. And so I don't think it can replace the broader sustainability ratings and rankings or the more comprehensive GRI reporting. Those serve a different function, and those remain important.
Okay, excellent. And next one, this one is quite detailed. It's specifically about business travel, which is an industry that has significant environmental impact and that has not been fully factored into business decision making historically. And we now have proof, thanks to COVID, that virtualization is a viable alternative to many business trips. So I guess there is a silver lining. So can hybrid metrics help us to better measure and communicate the true profitability of business travel in this unique moment of time? And if so, which ones might be most useful? So I think that please answer the part of the question that you can answer, which is, can hybrid metrics actually help better measure?
In theory, yes. If someone could tell me how to measure the value of my travel, the meetings I go to, some of which are helpful, some of which go nowhere, the presentations I give, some of which influence people's behavior, and might lead to people to join the Shared Value Initiative or hire FSG as a consultant. You know, how you measure the value, the economic value of the meetings that you go to is, I think, the hard part of this question. If you know the value, then yes, you can absolutely link it to the carbon emissions associated with travel. But I think it's a really hard thing to determine.
Moving on. So I'm skipping the questions that where we've already discussed. And next one is actually on the several cultural barriers are mentioned. So here is the short-termism, the incentive structures, the cross-team collaboration, transparency. So why are some companies able to get past these cultural barriers, and what can other companies learn from this?
They get past them, frankly, because the CEO understands this. It has to be led from the top. If the CEO believes that the social and environmental impact is material to their financial performance as part of their competitive strategy and positioning, then that will change the culture and behavior and organizational reporting structure within the company. If the CEO thinks that this is still part of your license to operate, your reputation, your philanthropy, your being a good citizen, it's not going to happen in the company. We're also seeing companies increasingly talk about embracing a social purpose. And there are a lot of companies that have just hired a PR firm to define a social purpose and put it up on the wall and haven't changed a thing. But those companies that really are embracing a social purpose are also making a major cultural shift that aligns with this. One of the most recent studies I've written is on PayPal. And PayPal has focused on democratizing access to financial services. And in particular, has developed a working capital loan product for very small companies that are typically too small to access traditional bank financing. And they have done somewhere around $14 billion worth of lending with very high success rates and profitability. But the only reason they discovered this product was because of this really intensive sense of purpose throughout the company, that what they want to do is make everyone in the world get access to inexpensive, reliable financial services. And that led them to identify this really powerful product, which, by the way, is being offered in Australia and the UK and a number of other countries, not just the US. So it's a commitment, a true commitment to social purpose, and a CEO who understands this that's necessary.
Okay, so I suppose this in some ways answers Wander's follow-up question to the Asian situation, which is, how can we accelerate? I see Gael is here, so I'll wrap up in just a moment. So how can we actually accelerate this shift in this region, in Asia, where, as you mentioned, where companies really are not quite yet there. A lot of sustainability teams, for example, are under the communications department.
Yes.
So how do we kind of kickstart this and push it forward?
Well, again, I think
targeting the senior management, really.
I'm sorry?
Is it about targeting the senior management, really, at the end of the day?
I think it is about targeting the senior management. It's also about helping people throughout the company understand this. It's about changing what we teach in business schools. And, you know, I'm glad to see Gail has come back into the picture. And I think it's, you know, companies should join the Shared Value Project in Hong Kong. And they will begin to learn from their peers how all of this thinking actually works in practice. It is something companies are learning from each other. It is something that they are seeing their competitors begin to do and realizing that they have to copy.
So peer pressure, Wander. So, okay, thank you so much. I really appreciate it, Mark. Thank you so much for taking the time to talk to us about this.
Thank you, Nadira, these are great questions, and it's a pleasure talking with you as well.
We didn't have the chance to get to all of the Q&A questions, but I think that Gael will kind of keep track of them, and hopefully we'll get to them at another time. So thank you.
Yeah, we were never going to have the time to go through everything, but thank you very much, Mark. We really appreciate you making time for, to come and talk to us here in Asia. Thank you, Nadira. It was great to have the APAC perspective on the global issue. So thank you very much. Thanks for your questioning and insights. Thank you also to the Global Network, especially Shared Value Initiative, who made this available, and FSG, Institutional Investor, and those behind the scenes at Shared Value Project in Australia and Shared Value Project Hong Kong. With all the current buzz around ESG reporting and investing, we will watch how the hybrid metrics approach is gaining traction. If you've enjoyed today's webinar, please follow us. And for those who are in Hong Kong, please join us at Creative Collision on 12th of November. Thank you all for your participation, for your questions, and we will get back to you if we haven't answered your questions. Thank you.